Howdy, Jacob here. Today we're looking at Consolidated Water in the water utilities industry, 427 million market cap on 331 million enterprise value. I will say I'm very surprised at that debt figure being net cash positive because a lot of utility businesses I look at are heavily in debt and their cash flow statement looks disgusting. Their earnings look great. To me, it feels very Fugazi-esque because their capex is so high. But anyways, 5.9% insider ownership, pretty good. Their market cap being greater than their enterprise value for a utilities company, definitely very good. Been around since 1973 in the Cayman Islands. Okay, maybe that's it. They design, construct, manage, and operate water production. Okay. So growth is very impressive. So it actually went down from 2014 to 2015, but since then, very consistently grown outside of 2021, but huge growth in 2022 and 2023. And it looks like there was one acquisition in 2023 that could have that be the case, but we're looking at massive growth here. Gross margin, not terribly impressive in the 30 to 40% range, but an operating margin still 10% plus, so not bad. A dividend that they really haven't increased in a while, but it does have a yield of 1.5%, very solid. It's not. It looks outside of the most recent year, it is a good amount of the earnings being paid out in a dividend. The return on invested capital historically has been pretty poor in the low single digits. Not well, they're starting to put in some R&D. That's kind of interesting. But otherwise, majority of expenses are just going to be cost of goods sold. Their balance sheet has 43 million cash on hand, no short-term debt, no long-term debt. Okay, we're feeling pretty good about that. Cash flow statement does show decent production of free cash flow with capital expenditures low in comparison. So that's pretty interesting to me because, again, like I said, I've looked at plenty of utility companies and I've almost stopped looking at them because their free cash flow doesn't make any sense. They're making 10% earnings margin and then they haven't made free cash flow in the last 10 years. This is a definite different case. They have not made free cash flow 2 years of the last 10, but outside of that, capex is very low and decent production of free cash flow. Their dividend does pay out $6 million. So if they're able to keep this $26 million free cash flow, obviously that's not a lot. But if you look at the average of the last 5 years, 6 million can be a good amount. Maybe it's 50% or so. But their use of cash really outside of that is acquisition. So tiny bit of, or maybe I'm just thinking maybe 20% acquisition, 5% investment, 50-60% dividend. Okay. So does that mean their cash position has gone up? Okay, a little bit. Let's start making some assumptions here. So on the revenue growth side, I think that from here, this is a little crazy. I don't know what, with a crazy 1 year, I never know what to think. Maybe just like 1%. I always err on the side of conservatism when I'm not really involved in the business and don't understand everything. And so for me right now, 1% seems fine. Like they did make an acquisition, so that's why it did grow a lot. So it's not like this is all organic growth and it's likely going to dampen down to more reasonable levels. But I don't know, maybe that seems fine to me with a P at that time. I don't know. A lot of utility companies have like geographical moats because you can't really get service elsewhere. I know where I live, not necessarily water, but our utilities for electric is through one company and there is no other option. And so they do have that kind of moat status going on. So maybe a 14, or let's just do market average because I think growth could be hindered, but they just have a dominance probably in that region. And margins are pretty consistent. Maybe let's do a little bit of a range here, 8 to 10 with a share change of nothing because they're not buying back any shares. And I don't think their stock-based compensation is really going to put a dent there. So these assumptions, we're saying it needs to fall 73% before you get the return I'm looking for here. I do think it's an interesting business, one that I would consider looking more into, but I don't think the growth is necessarily there. It's out of the Cayman Islands, so I don't think it deserves a premium necessarily, even though they do possibly have a geographical moat. So for me right now, I'm just waiting, looking at other businesses in the meantime. So hope you enjoy the video and have a great rest of your day.